the whole of Europe is shutting down. So what's that going to do to global GDP? What's it going to do to American GDP? What's happening in America? I mean, we're only, both the UK and America are going down the same path as Italy and Spain. And we are a week or two behind them, that's all. The effect on the economy, I mean, if you imagine it's bad, then your imagination isn't too far away. It's a lot more accurate than anything that you will be told. We're looking at 1929 to 32, when Wall Street fell by 90%, and we led into the Depression. So that is before the coronavirus. This is very serious.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest who brings great perspective from overseas, where he is in the UK, Alasdair Macleod, Head of Research at goldmoney.com. Alasdair, thanks for joining us again here on Reluctant Preppers and Liberty and Finance.
That's my pleasure.
Today is Monday, March 16th, 2020, and we have to check in on what's apparently a market crash globally. We've had extremely volatile times over the past couple of weeks, with markets having hit all-time highs just recently, and now concern about the coronavirus and market forces that are shaping our world. Can you bring us up to date quickly on what's going on in Europe in the markets, and then what's happening with precious metals?
Well, firstly, what's happening with markets is that they're continuing to crash despite the Fed's massive bazooka, I think someone called it correctly, injection or promised injection of money. I mean, if you take up all the promises that have now been offered by the Fed, you're looking at $1.5 trillion in repos. You're looking at 700 billion, 500 of which is in U.S. Treasuries, and 200 in agency debt, and that's QE. As well as there was 60 billion last week of purchases, if you like, of government debt. I mean, all that adds up to $2.206 trillion in 1 week. You would think that the markets would say that's enough liquidity for things to stabilize, but no. We're collapsing. As far as I can see, the American market in terms of futures is still limit down, so you've got no trading there. But European markets are down 7-8%, that sort of figure, from Friday's close. And I mean, last week was pretty awful as well. One notable feature this morning is that after a brief pause, they've really bashed gold and silver prices, and particularly silver. Silver's now trading. I lose track of the big figures. I think it's under $13 now. I mean, it's just unreal. But there is a very simple reason for that, and that is that the establishment, the bullion banks, are very, very short of futures and forwards. And also on their unallocated gold accounts to customers, they are also short technically as well. So they have an interest in using this chaos as a cover for trying to recover their short positions so that what they see going forward is less dangerous to them. I think it's very important to realize that the fact that futures and forwards are being hit so badly is evidence that the establishment has actually turned bullish on gold. It wants gold. It needs gold. Otherwise, if it doesn't get gold, there will be bullion bank failures. There will be force majeure. You've got all those things. So they are looking forward, if you like. The thing that's interesting about it is that it's completely divorced from what's going on in the physical markets, where people are queuing up to buy gold, silver, whether it's coins, bars, whatever. And all around the world, prices being quoted, where they have anything for delivery, is with significant premiums over the spot price. The spot price, of course, being settled in the futures markets. So this is something which, people who have gold as part of their wealth, if you like, should not worry about it. It is confirmation that they are on the right track. Ignore prices. Markets are broken. Prices are meaningless. I mean, even in US Treasuries, usually you get a one-tick spread on an existing Treasury stock. That's widened out to something like 25 basis points. And not only that, but the size of the quote. In other words, the amount of treasuries that a market maker is prepared to deal in has actually been reduced very substantially. You could say, I think, with great justification, that the prices on the screen are purely nominal and not realistic. So this is a chaotic scene. The Fed has lost control over prices. Whether it regains it or not, I don't know. But after last night's bazooka, so far it has not regained control of prices. And I suspect that there may be a period where they appear to gain some sort of control because things will settle down. I mean, they always do settle down. Now, whether that's later on this week or whether it's another week or two, I don't know. I suspect later on this week, things will settle down. But that will be an interim period, I think, before the bear market really does hit. The reason I say that is that the principal problem that the current coronavirus has given the central banks is it has interrupted payments along supply chains, ordinary retail business.
Right.
It's not just a demand shock, it's a supply shock as well. So we don't quite know in what proportions this will pan out. But to give you an example of the scale of the problem, don't look at GDP, but look at gross output. Now, gross output is not just GDP, but it is a sum of all the transactions that go in from the earliest stage of production going through to the final stages of production and the sale of the goods. So, I mean, GDP is just the sale of the goods. So typically, you could see that with all the payments along the way, you're probably looking at a gross output of 2 or 3 times GDP. The payment failures are in that 2 or 3 times of GDP. Now, incidentally, the US has started collecting gross output figures, and you can look at them. And I think the current figure, annualized, is something like 30 trillion. In fact, it's a lot more than that. They don't capture it all. And the other point I would like to make is if you look at the supply chains, the gross output numbers in America only measure those portions of supply chains in America. They don't measure the gross output running up to the imports that go into the supply chains.
And certainly with increasing overseas aspects to the supply chains, many manufacturing operations have moved a lot of their production overseas. So if you want to see what's being produced in the U.S., it doesn't start there in many cases, yeah.
Absolutely. So what we're looking at, DK, is a potential supply chain disruption, which means that payments in the order, I guess, of something like 50 trillion could be involved. Now, not all of that is going to be payment problems, but that is the pool that will provide the payment problems that the Fed has to deal with if it seeks to stop the US economy and the global economy from crashing.
That helps. It really helps to explain why in the past we've talked about each country's central bank having to try to shore up their faltering economy, but why the Fed, people talk about globalist schemes or globalist designs that they have to create a global system, that sort of thing, which I won't weigh in on that, but just to say that just from a practical standpoint, observing the actual structural realities of the interconnectedness of the economy is in this globally distributed manufacturing and so on, you simply can't, if your mission is to supposedly resurrect the U.S. economy, you can't do it by only having domestic policy. You've got to look outside that because the tendrils of the supply chains absolutely are established globally, is what you're saying.
Yes. To a small degree, the Fed is prepared to help deal with this problem because it has currency swap lines with several major central banks. And those are the Bank of Canada, the Bank of England, the Bank of Japan, the Swiss National Bank, and the ECB. But the supply chains are not just in those countries. There are no swap lines with the Bank of China, the Bank of Korea, the Bank of Taiwan, whatever that's called, or any of the other central banks in the manufacturing centers in Southeast Asia, particularly Southeast Asia, nor with the Reserve Bank of India, which is also a supplier of goods to America, particularly pharmaceutical products. So the idea that the Fed can act as the central bank backstop for the world through its swap lines is actually not correct. So what does China do? Well, China really has two sources of dealing with the problem where dollars are involved. The first is that it has FX swap lines, or FX swaps, if you like, so they can swap out of their currency into dollars. And what they've got is they've got a dollar reserve in swaps. They also have cash on deposit in the system. They have treasury bills, other short-term instruments, and they also own treasuries. They're going to have to liquidate some or all of those in order to deal with the problems that mount in their economy from the dollar supply chain conundrum, if you like. Taiwan has the same problem. So does Korea. Korea in the past might have relied on drawing down through Japan on the FX swaps with the Fed, but that's expensive, and they may indeed resort to other angles. Now, I think the point that's worth making in the general sense for these problems is that far from countries like China, India, Korea, Turkey, whatever, needing to go out and buy dollars, they already own dollars. What they lack is dollar liquidity. So they are likely to raise dollar liquidity by selling dollar assets, portfolio assets, treasuries, the T-bills and things like that. So this is likely to be a huge headache for tomorrow. Not today, but for tomorrow. And by tomorrow, I really mean later this week and maybe next week. I mean, it's evolving that rapidly.
So let me understand. A lot of international holders have dollar-denominated assets. So in other words, you can say that they're in the dollar, but that's not available to them for covering their short-term liquidity needs, that sort of thing. So in order to get this cash that they can slosh around to deal with real problems that they're facing, they've got to sell a lot of these dollar-denominated assets, and that's going to cause a wash of liquid dollars. That
is correct. I can quantify the numbers a bit. If you're looking at securities with a maturity, equities and bonds with a maturity of a year or more, the last estimate we have is around about $19.5 trillion worth. If you're looking at securities with a maturity of less than a year, which are short-term treasuries, T-bills, FX swaps, deposits held with New York banks, and so on and so forth, through the corresponding banking network, we're looking at a further $5.6 trillion. So this is like $25 trillion the foreigners already own. That's why they don't need to buy any more. And this is a point which so many of my American friends miss. They really think that the Triffin dilemma, that basically because the dollar is the world's reserve currency, means that foreigners will always be buyers of dollars. Now, that is generally true until they get to the point where they have got too much dollars for the existing and prospective purposes of their requirements. And that is why you have a collapse in the dollar. First one that we know in modern times was when you had the devaluation from 20.67 down to $35.
1933.
That actually, the suspension, if you like, of anyone owning them was 33. This was the end of January 1934. The second instance of this was the failure of the London gold pool, which was in the late 60s and led to Nixon getting rid, if you like, doing away with the Bretton Woods Agreement. And it looks to me as if this is the third one. Now, what is interesting is that there is a general conviction that because the economics, if you like, in somewhere like Japan or the Eurozone is so awful and terrible, and I mean, you're looking at a potential banking collapse. In fact, as every day goes by, it's a more certain banking collapse of the European banking system, the Eurozone banking system. Now, if that occurs, your gut would tell you, don't buy euros. But actually, what's driving this market is the fact that everybody's got dollars. And if anything, they're sellers of dollars, including the hedge funds who were ripping out the difference between Eurozone interest rates and the rates that you would get on a US T-bill. That's now closed right down. So we don't know how many trillions of this. This is all in the FX swap market again. I mean, the FX swap market is a huge problem. You will find that those FX swaps have got to be closed. And what it means is, on the one hand, dollars are sold, and euros which are being borrowed basically are bought to close the position. So that is what's going on, if you like, in the forex market. So a lot of this is counterintuitive, but actually you can work it out if you think it through. So here we are with broken markets. The first effect has been to drive the values of US treasuries up through the roof by pushing the yields down. This is a residual belief, if you like, in bond markets that the Fed actually controls things, a belief that the rate of inflation is 1.3% core rate or 2% or whatever. That is absolute nonsense, as I think we've discussed in these podcasts before. The true rate of inflation is close to 10% by independent analysts. There is no such thing as a measurable general rate of price inflation, which allows everybody to come up with whatever opinion they want, which is actually what all governments have done. They've said there's no effect on price inflation, or it's not even struggling up to our 2% target, or whatever. It's a load of rubbish. It's all in there. I mean, 10% is a lot closer to what the truth is than 2%. So where does that leave the value of US treasuries? The correct value for US treasuries, once markets regain control over pricing from the central banks, is for a 10-year US treasury to be priced at under 50. Under 50. In other words, half the current notional price, given the yield is 0.95% or whatever it is in the market today, supposedly. So the move from a controlled price bond market to a bond market that sets its own prices is to expose the wild overvaluation that the Fed and other central banks have put on government debt. The implications of this for the US Treasury are extremely important and very, very negative, because if they can only fund at a rate which is closer to 10%, then obviously the finances of the US government have spiraled out of control. So what do? Does the government shut down in an election year? I mean, this is something which is very difficult for them to do. And things will get cut. I mean, they will cut spending. Generally, spending, if you like, that hits the consumer.
Well, we've certainly seen no sign of spending cutting at all. No, if anything, over the past 2 weeks, we've heard pledge after pledge of we're going to unleash the full power of the federal government to address the coronavirus. We're going to bail out this industry, the travel industry and the airline industry and every industry that's affected by this. We're just awash in promises of, Mnuchin saying we're going to use unlimited amounts of capital. Unlimited. And that is on a starting base of an estimated deficit for the current financial year of just over $1 trillion. What's it going to turn out to be? I mean, basically, the Fed is going to have to fund this. The market won't. So you're looking at a US Treasury problem in that they're probably going to be running at a deficit of annualized of
2 trillion a year, so month on month. That's the amount that you're going to have to run towards. You've also got to absorb foreigners' sales of US treasuries. And who's going to do that? Well, if the Fed is going to try and maintain prices, it's the Fed, it's no one else. And the Fed has the problem that the banks are illiquid. This is really what the repo market is all about. And this was first exposed back in September, before the coronavirus even started. So this is not just a coronavirus problem. I mean, as we've discussed before, we're coming into this at the end of the credit cycle, at a time when the dynamics are actually quite similar to what existed in 1929, a combination of the end of the credit cycle and at the same time trade protectionism. Now, the trade protectionism in 1929 was worse than it is today, but the extent of the stimulation, the monetary stimulation, through bank credit in particular, was not nearly as great as it today. So we're looking at two things. Now, okay, different quantities, but I can tell you that if you sort of try and guesstimate a net effect, we're looking at 1929 to 32, when Wall Street fell by 90%, and we led into the Depression. So that is before the coronavirus. This is very serious. Now, what the coronavirus has done on top of that is it's created chains of payment failures. And to try and estimate what that is, we've got to think in terms of gross output, not just GDP. And so we're seeing a significant part of a total pool of roughly anything between 50 and 60, 70 trillion, if you like, worldwide in those payment chains, dollar payment chains only. I'm not talking about other currencies. And can the Fed really backstop that? Because all these payment failures end up in the banks one way and another, and the banks will contract their credit. Oh, and that's another problem, because the Keynesian idea of central banks running the economy, they shall not permit, under any circumstances, the contraction of bank credit. We're going to get a contraction of bank credit because obviously, you have a business, you have people to pay, you have some cash in the bank. What happens? You draw down on the cash in the bank. That reduces one side of the bank's balance sheet. They need to go and get the liquidity from somewhere else, which is actually what we're already seeing, incidentally. But at the end of the day, one side of the balance sheet starts contracting like that. They have to start contracting the other side of it. So this is a very serious situation.
In addition to the dynamics you've laid out here, if we could circle back to the impact on precious metals prices, because you're talking about this ocean of U.S. dollars that are being released, and that dynamic is going to continue because some of the driving factors that are pushing it. Isn't that tremendously bullish for precious metals? And can we look once again? We have a question, in fact, on this point, and I'm sure our viewers are wondering. Patrick Clayton says, Alasdair, the disconnect in prices between physical and booming demand and the fake naked short derivative trading at COMEX is beyond a joke. When, if ever, will there be a decoupling of the pricing of the actual physical metals from the fraudulent paper trades over at LBMA and COMEX?
Well, I'll come to that question in a moment. Rather than seeing the price of gold rising, actually what we're seeing is the purchasing power of fiat currencies falling. That probably puts into a better context the immediate effect in the market. There's a shortage of dollars. We need dollars. They can either come from selling existing assets or drawing down on facilities provided by the Fed. So you've got liquidity being withdrawn from the market. And of course, that does mean that the purchasing power of the dollar in financial markets would appear to be tending to rise. And this counteracts, if you like, the general medium and long-term trend for the purchasing power of the dollar actually to fall. That trend will reintroduce itself, I think, fairly shortly. The effect of that will be that the price, if you like, of gold measured in declining currencies will rise very substantially, because another way of putting it is what the Fed is doing, and what every central bank is doing, is they are sacrificing the currency to support asset prices, financial asset prices. Now, this was exactly what happened 300 years ago in France, when John Law basically started printing livres and livre credit from his Banque Royale to buy shares in the Mississippi venture to support that price so that he could merge the two together. He had an objective in doing it. But he was financing the purchases when other people were selling by printing money. What is the Fed doing with financial assets? There is no difference at all in the current monetary policy compared with that of John Law in 1719 to 1720. It's a very important point to realize. Now, what happened, as we know, is by the end of 1720, in fact, by September 1720, the livre was worthless. And we know it was worthless because there was no exchange rate for it from that moment on in London with sterling. So he destroyed his currency, trying to keep financial asset prices buoyed up. It so happened that the Mississippi venture, it fell from a high of around about 11 or 12,000 livres down to around about 2,000 livres, something like that, in September 1720. But it was 2,000 worthless livres. So it was completely worthless. And this is the problem, because once the dollar starts sliding, then those foreigners have got a problem. They see falling asset values and a falling currency value. They're getting hit twice. That is only going to speed up the liquidation and the selling of dollars to the tune of $19.5 trillion of 1 year or more maturity bonds and equities, and a further $5.6 trillion of short-term debt and bank balances. So, this is huge. This really is huge. And the effect, I think, once this initial destabilization has happened on the gold price, will be substantially higher. And if the John Law example is followed through, then in terms of dollars, the price is infinite.
And that seems to lead us to the moment that in this time we are in right now, where there's still some physical availability of precious metals at these remarkably low prices historically in fiat, it seems like a great opportunity for people to take advantage of that. I mean, is that your view as well? Yeah.
Well, I put it slightly differently. I don't look at gold as an investment. I look at it as money. What I don't want to hold is fiat currency, because I know it's going to zero. I want to hold real money. And if you call money an investment, then so be it. But you're missing the primary purpose of actually owning some gold, owning some silver.
And other real assets like real estate, there's a question here from Sally Maynard, who says, will house prices drop?
I think that is interesting. I think the first thing to understand is that residential property is not a financial asset. It is a solid asset, if you like, if you want to call it an asset. It is a durable good, actually. That's the correct way to look at it. So in terms of collapsing paper currencies, at some stage, yes, it will, prices will do more or less what gold will do, but, perhaps a bit less so. I mean, that was certainly the experience back in the Weimar Republic, when foreign students, from America and elsewhere who were studying in Berlin, out of their stipend, as it were, their allowance sent by their parents from back in America or from Britain, were able to buy streets of houses. Now, they retained their value a lot better than any financial asset would. But having said that, it was way down the list compared with gold. To answer the question more fully, the first hurdle that property has to get over is the liquidation of the debt with which it has been purchased. The price of property does depend on an efficient working mortgage market. You take that away, prices would be considerably less. So you've got to work through that crisis before you can truly say that residential property is an escape, if you like, from this mayhem that is erupting in financial circles.
So help us understand how that plays out in practical terms. Does that mean that we'll see some volatility in between now and when prices are likely to end up lower for real property?
Yeah, certainly I would see volatility being the first thing. And the volatility initially, I guess, would be on the downside as buyers can't get mortgages, buyers withdraw from the market, whatever. And if you're refinancing, then the cost of refinancing is going to be at a far higher interest rate than we have at the moment. I mean, the moment it's lovely. If you can find a mortgage, someone offering you a mortgage at 0.5% or 1% or whatever, or if you're in Denmark, you can actually get a negative rate mortgage because of the way the system works.
So if I could just hold you there, why people are anticipating with all these terrible financial, economy in turmoil and supply chains bogging down and all this, that with lower economic activity, the real economy is going to slow down, and that would actually mean that the policymakers are going to have to try to keep low interest rates going for a while, but you're saying high interest rates. So what brings us from low interest rates to high interest rates?
Okay, well, it's quite simple. We were talking about the yield on U.S. Treasury debt, what the correct level is if it was to reflect what's going on with price inflation. I mean, it should be half the current level at least, and then possibly some. Now, you can't, as a central bank, manage government debt, because one of the primary purposes of the central bank is basically to fund the government. You cannot manage that by keeping interest rates at zero, while nobody will buy debt at anything less than a 10% yield, if you like. I mean, taking a 10-year, obviously you get a yield curve. So either the government is financing off expanded treasury bills, sort of the whole time, or the central bank is forced, usually to defend the currency, to raise interest rates. I mean, this is the whole point. What we're seeing is the central banks are losing control over the pricing in financial markets. And that also includes the cost of borrowing. And the cost of borrowing not just for you and me, but for governments as well. So, sorry, that you interrupted about interest rates. So going back to the mortgage argument, you can see that there are going to be some very rough, choppy waters. What I would hope your viewers has locked in the current rate of interest, if you like, and hopefully a relatively low rate of interest for the next year or two, possibly, preferably 2 years. Because then she will, if you like, be able to ride out. As long as she can make the mortgage payments, she will be able to ride out this rather nasty situation until the time when the collapsing purchasing power of the dollar means that the effect on house prices is to drive them up in dollar terms. Okay, they're not going up in gold terms, they'll be going down in gold terms, but they will be rising in paper currency terms. I hope that's not too confusing.
It's certainly, these are confusing times for people, because it's what used to be the ground beneath our feet, what people thought, which was the currency of our country, is shifting so rapidly, and the tectonic plates that it's perched on, which aren't visible to the ordinary person, are moving, are really starting to break up, and so it's very disorienting for most people. We have a question from New World Forward, who asks, in the face of draconian measures taken by governments to combat the coronavirus, I assume we're talking about enforced quarantines and shutdowns of all sorts of aspects of the economy, do you think central banks will succeed in pushing the stock markets higher while global economic activity slows to a crawl?
No. Simple word. The problem we have is that nobody is admitting to the extent of the problem. I mean, amazingly, I think it was 10 days ago, the IMF came out with a forecast of the effect of the coronavirus on the global economy. And do you know what they said? They said, we think it will knock 0.1% off global GDP growth. I mean, for goodness sake. This is the problem that the authorities have, is they're terrified of frightening us into non-activity. the reality of the situation is that this coronavirus is basically hitting activity. I mean, we've seen in China for a couple of months, it's probably knocked about 80% of GDP out of the window. Whether it ever gets captured or not, I don't know. That's something I can come on to in a second. But we've got the same problem in Italy. What's the GDP? With the only shops allowed by law to be open are the
pharmacies
and food shops.
Yeah.
Or, there's a picture in our paper today of a very famous Parisian restaurant, Les Deux Magots, which incidentally translates into the two dealers, with one person sitting outside reading a newspaper, otherwise shut. The whole of Europe is shutting down. So what's that going to do to global GDP? What's it going to do to American GDP? What's happening in America? I mean, we're only, both the UK and America are going down the same path as Italy and Spain. And we are a week or two behind them, that's all. So, in the next week or two, you're going to see more realistic estimates of the effect on the global economy and the American economy. All your viewers, I guess, are in America, basically. The effect on the economy. I mean, if you imagine it's bad, then your imagination isn't too far away. It's a lot more accurate than anything that you will be told. There was one other point I wanted to make in this, and that is that if you print loads and loads of dollars and you push them into the economy, then that will make GDP appear to be better than it would otherwise be. So what I'm saying is, don't rely on statistics. Statistics can tell you anything but the truth. The one thing it won't tell you is the truth.
We have a question here from Fred Flintstone, who asks, if the central banks buy all the stocks and all the corporations, then what do the people own?
I think that's a very good question. I think if I could sort of continue in a line that Fred Flintstone might understand, just the rocks around him. And that's it. And he will make something out of those rocks, whether it's a wheel or a table and chair or... It's so long since I've seen the Flintstones, I can tell you. But I seem to remember that was the essence of it.
If we could turn back to precious metals for one more time, people are seeing this bewildering dichotomy of falling prices and no availability. That seems to defy the laws of nature. Can you help us understand how you think in slow motion? How does that play out?
Well, it's broken markets, isn't it? At some stage, I think that people will price things themselves and not the central banks. And that, if you like, is what happens when you get what they call a market failure. It's not actually failure of the market, it's the failure of the authorities to control markets. How long it'll take, I don't know. But I think in this podcast I've given some sort of steers, and it's probably worth people listening to it again to really understand the message. But I think the starting point without the coronavirus was a 1929 to 1932 situation in the stock market. Things are very different today. There are different problems and all the rest of it. But if that's the starting point upon which we impose the coronavirus problem, then you've got a huge, great chain of payments problem on top of it. I mean, basically, anything that is manufactured for the consumer has so many inputs. And basically what happens is that as the various inputs are manufactured, the payments start going the other way. So there will be a lead and a lag in it, but when you go out and buy something like a box of matches, then that box of matches, if you like, starts funding the next series of matches through the assembly of the boxes, which in turn take a number of different operations, which require chemicals which are provided by someone else, the matches themselves, which are cut to size, to shape, out of wood, and you've got also the tip on the end of it, if you like, that when you strike the box, it flares up. And you've then got the timber importers. You have got the the people who fell the wood, you know, the Macmillan Blodells and all the rest of it, who do all that sort of stuff, anything that's made has actually got a complex chain behind it. The payments on all these risk being disrupted by the coronavirus. And some companies have no cash or don't have enough cash to survive more than a few weeks, or at most a month, maybe two. Some companies with cash will be drawing down their cash to pay their, you know, the bills that come in. They still come in, and you got to pay your staff and all the rest of it. People will get laid off. So to some extent, in welfare-driven states, you will find that the way in which they fund themselves will be shifted onto the state, because the state will have to be paying for various things. And the states already have this huge, great extra burden on top of a budget deficit of having to gear up health services. I mean, goodness knows what's going to happen in America if what's happening in Italy does transpire in America. And the indications are that it's almost certainly will. I mean, you don't have a health system where people get things for free. I'm not an advocate of free health, I can tell you, but this is just the one exception, if you like, which makes a country stronger. But even then, a country like the UK, like Italy apparently has got a very good healthcare system. I've never had to draw on it, so I wouldn't know. I'm just told that. I know that from our experience in this country, we do not have the capacity to deal with the coronavirus problem. You're going to get people dying at home. I'm afraid it is going to be terrible.
There have been some very concerning but well-produced videos made recently by people who are epidemiologists, and saying that if you just look at the inescapable trajectory of the exponential growth and the numbers and what the curve is likely to be, that we're likely to see basically an overwhelmed medical system, even in the U.S.
Yeah, indeed.
This is a practical question from Joe Taz, who says, if we need to sell our gold for rent, mortgage, etc., how do we do it if the government has put us under quarantine and we can't leave home?
Well, most payments are delivered electronically now, I think is the simple answer. And as long as you've got electricity to drive your computer and the internet doesn't foul up, then that's the way payments will be made. And I mean, at Gold Money, we have cards, debit cards, so I can draw down on my gold, preload my debit card, and spend off that. And I can do that locally in the shops. It's a MasterCard available, works everywhere. In this country, the story is that they're going to tell 70-year-olds to, which I'm unfortunately, I hope I don't look 70, but I am.
No, you don't.
I'm more than 70. I'm going to be told to stay at home and stay there probably for a month or two, which will drive my younger wife, wild, I'm sure. It'd drive me wild. The thought of being able to lie in bed and just sort of get grapes chucked at me occasionally is sort of attractive in one sense, but more seriously, there's going to be massive disruption, I think, as this progresses. And so payments are something which will be done increasingly electronically. The payment for goods will be electronic. And so I think, one of the growth businesses basically is Amazon and the various online grocery delivery services. The elderly are going to have to rely on that to a huge, huge extent. And where they don't have, sort of the computer technology, because don't forget, 80-year-olds came in really just a little bit too late on average to benefit from the development of personal computers. So a lot of them are computer illiterate. And so they will have problems. They will have huge problems. And we're going to rely on neighbors. I mean, we live in a village of a couple of thousand people. We're going to have to help make sure that people, aren't cut off, if you like, from the things that they really need. And I think that's going to be true in America. And I would urge everybody to think in a community basis rather than on a selfish basis. I mean, this idea of just prepping and, going up to a mountain lodge somewhere and hiding from the world and is actually fundamentally antisocial. I think we need to help our fellow human beings, and particularly those in our own community.
That's particularly challenging at a time when there's all this concern about contagion, that sort of thing. It really puts an added crimp on the need for the restoration of community mutual support.
Yeah, indeed.
Jeff Hoyer asks, what happens to mining stock during hyperinflation? Do they historically survive a currency reset, get nationalized, etc.?
Well, difficult to say. I mean, we're trying to double guess what governments will do in the future as they become destabilized. I can't see that nationalizing mines makes any sense whatsoever, because governments are less efficient at running businesses than individuals. So
that's never stopped them from taking over other parts of the economy.
Well, no, absolutely. But what that would do, I mean, I'm not saying that they won't do it, but what it would do is it would restrict the future money supply of a system which accepts gold as sound money, which we know is going to happen at the end of the day. Gold will be sound money. It will come back as sound money. It will, because even if there is a reset, and everybody tells me there's going to be a reset and so on, I mean, it wouldn't surprise me if they try it, but a reset won't work. It would be rather like the relationship between the assignats in France in 1782-ish, I think, 1780, in the 1780s, when the assignat was introduced. And this was a new bond which was to act as money, and it was meant to be secured on the back of nationalized assets. The state had nationalized church assets, because before then the Catholic Church owned roughly one-fifth of all the land in France. But they couldn't resist issuing more lines of assignats, and so the purchasing power of it went down, and we had the revolution throughout all this, and the contribution of the collapse of the currency to the French Revolution has never really been stated, but I can assure you that it would have had a very large part in it. They then replaced that with something else called the mandat, because by then everybody hated the assignat. They didn't want it. They wouldn't accept it in payment. So they produced a new currency called the mandat. And guess what? That lasted 6 months. I mean, you cannot have a reset from a fiat currency system and expect it to work. It doesn't work, because it shows a complete lack of understanding of what the problem is. There's an understanding that will happen, because I guess that, the whole world now of central banks is driven by Keynesian economics, which incidentally is rather hard to distinguish from John Law's economics going back to 1720. So, there's going to be some lessons to be learned, I think, before we actually get towards currency stability.
This begs the question from Hadi Nuf, who says they will try to restart the financial system with what? And that's one of the concerns, because whenever we've had a guest talking about the virtues and the reasonableness of a precious metals like gold-backed financial system, we also get the sort of the realists who chime in and say, once the intoxicating power of fiat has been practiced by those in control, they're not going to just relinquish that for let's get a sound foundation in. So what do you think are realistic points paths that we could take forward given human nature and the powers that be and so on?
Well, the authorities relinquishing control is something they will never do.
So far, that sounds realistic.
Actively,
right?
I mean,
voluntarily.
It may be forced. It may be forced upon them. I think it will be forced upon them. But the twists and turns until we get to the point where it's just completely abandoned. I don't know. It's going to be different in different countries. I mean, if you look at Russia, Russia has already paved the way to putting the ruble on a gold standard, and I think that they could realistically do it. What might encourage them to do it is if they could think that by doing it they would screw the West into the ground even further, then that might encourage them to do it, because I think Putin would be quite happy, in a sense, to come out on top of the world, if you like, on top of a destroyed America without actually having to go to war. in the physical sense. So that wouldn't surprise me. The extent to which the Chinese understand this, I think, is more difficult to analyze because they have used Keynesian methods to promote their economy for the last 30 years. Originally, I know for a fact that the state accumulated gold. What is questionable is the amount of that gold. Having looked at the flows from the enabling legislation, which is dated 1983, until 2002, when the public were then permitted to own gold, I end up with a figure working on contemporary prices of around about 20,000 tons. Maybe less than that, I don't know. Who cares? I mean, but it will be a significant figure. Russia also, I guess, also has gold, which she hasn't declared. I mean, the amount that she announces month per month is actually just going in. That's just, the physical gold reserves in the central bank. As far as China is concerned, they have moved. I mean, they started off in the early 2000s, before the Lehman crisis, by encouraging people to buy gold. They even advertised, sort of on hoardings, it's your duty to buy gold. And the effect of that is that other people have estimated that on the basis of withdrawals from the Shanghai Gold Exchange, the public now own a further 17,000 tons of gold. So between the state and the public, you're talking about 37,000 tons of gold. But whether the Chinese actually understand still that the only currency that will survive is a proper gold-backed currency, freely exchangeable for gold on demand by the public, I don't know. Have they been Keynesians too long to have forgotten that lesson? I don't know. Throughout Asia, the people accept gold or silver as real money, rather than, if you look at Indonesia, it's a very, very good example. You've got a parallel monetary system. You've got the Indonesian rupiah, which is only a one-way ticket, and that's down, 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 down. Lunch in Jakarta will now cost you 1 million rupiah, just to give you an idea. And there's a network of pawn shops. So if you're a small businessman and you want to acquire an asset, whether it's a new taxi or something like that, you take some of the family's gold, which means you've got to get your wife's permission, which may not be forthcoming. You've got to persuade her, and you take it to a pawn shop, and the pawn shop will advance the rupiah for you to buy the taxi, and then out of your earnings, you gradually recover your gold by redeeming it from the pawn shop. So that is the way it works in Indonesia, and that's why there's so many people without a bank account in Indonesia. And the same is true in India. The farmers, their life pensions are in gold. And what a wise policy it's been. The first time I went to India, gold was worth something like 180, 200 rupees an ounce. And that's back in 1967. Now it's 120,000 rupees an ounce. So, where else would an Indian have put the family pension fund, if you like? Where would you have put it with such security and such notional returns? There was no way. Not even the Indian stock market would have offered him that. And anyway, he didn't have the facility to access the stock market. He had no alternative, and he was very happy with that. And his wife wears the bangles and all the rest of it. You see the Indian women, they're wearing the family pension fund. And you've got to get it off the wife in order to spend it. And this is actually a pretty good control on family finances. The Indians have got that bit right. Sorry, I interrupted.
Just before we wrap, you mentioned in passing, wouldn't Putin like to be able to defeat the West without having to fire a shot? Some people have been claiming over the past month that the crash in global oil prices is not just due to decreased industrial demand or transportation demand and the failure of a political solution from the OPEC nations to agree on production quotas, that sort of thing, but actually an intentional pressure from Russia on the U.S. shale and fracking industry and so on to try to drive an advantage there. Do you have insight into what's going on in the oil pricing and world balance of trade?
Well, insight's probably too strong a word.
A hunch?
But yeah, a hunch is probably a better one. If you look back, I can't remember now, really to the time when the shale industry started. I think that's probably just a little bit before the Lehman crisis. Yes, it was, if I remember correctly. There was very much the intention, I think, to replace global imports into America by gearing up on shale.
Domestic production, yeah.
Yeah, and I think that the Russians saw this almost as a sort of attack against their market. And various developments in the shale market since then, I think has rather convinced them that is the case. So this developing situation with the coronavirus and self-evidently a collapse in the prices ahead, with just too much oil around, it was too good an opportunity, I think, for the Russians to not take. And as I understand it, the OPEC meeting which they sat in on, it required their agreement to limit oil production. And they said, no, it's not negotiable. End of story. End of meeting. It was as simple as that. And then, of course, the Saudis are then put in a position where, their lifeblood is income from oil. So they have to sell what they can as quickly as they can, particularly since they listed their oil company. And I can see that, if you want to earn anything out of oil and you're an oil producer, you just got to pump like crazy. And so that's the situation which the Russians have triggered. They don't mind. They've got gold. They've got the stability. They've been through all this before. Also, the democratic responsibility of Putin's government towards its people is, let's say, less strongly tied than it is in the West between governments and their people. So he can afford to pay fast and loose a bit without actually having to deal with the domestic fallout.
Popularity.
And that's what he's done. That's what he's done. So yeah, I mean, I think he's sitting pretty. He's always been sitting pretty. Everybody's tried to get rid of him. I mean, with Ukraine, with trying to sort of break up the partnership with Russia. They've all been trying to get Putin one way or the other. And everything that anyone does, look at Syria. Who comes out smiling out of that? The Russians. And they'll just get the Chinese to come in and rebuild it. Yeah, this is Putin's style. Just basically, come on, man. I'm a judo master. I know that you will produce the energy for me to throw you, and that's his approach.
Well, Alasdair, we're out of time for this session, and it's certainly grave times. We'll be finding out more in the next few weeks and months about the progress of not only the global contagion, but the financial contagion and the top of the credit cycle and the protectionism and all of that you've discussed with us. We'd love to have you back on again. We've been speaking with Alasdair Macleod, Head of Research at goldmoney.com. Alasdair, as always, thanks for joining us.
That's very much my pleasure.
Hey everyone, since I started this channel over 6 years ago, my mission has not changed. It was then and is now to help as many people as possible to take care of our families and protect ourselves from the undue risks that we're facing from our fiat financial system, the banks, the Fed, and now the tumbling stock markets. If you've decided that now is time for you to take action by obtaining real money, physical precious metals for your family, I can now fulfill my mission in a new way, because I've established a relationship with Miles Franklin, one of the oldest and most trusted names in precious metals in the United States. Over 30 years, family-owned, rated A+ by the Better Business Bureau, with 0 customer complaints over their 30 years of service. If you've decided that now is the time to take action and to acquire physical precious metals, just email me at libertyandfinance@gmail.com. I'll get you connected with the right licensed and bonded dedicated agents who can help you acquire the physical precious metals that you need to protect your family's finances. Again, email me at libertyandfinance@gmail.com. I'm confident that together we can take better care of our family's financial futures.